Greetings, and thank you for watching my equity research report conducted on Target Corporation. I am Kadeem Myrick, and I am a current graduate student at the University of Memphis. As you can tell by the first slide, I've listed the market price, the target price in 1 year, as well as my recommendation. As you can tell here, as of October 24th, 2014, the market price was $61.57. Through an analysis, which you'll see later in the presentation, the price target for 1 year will be 53.83 cents. My recommendation to investors who hold Target Corporation stock would be to sell. I chose Target Corporation because of my experience with them over the summer in one of my accounting courses. Basically, we were charged with the task of examining the financial stability of this company. And at the time, they just experienced a leadership change, as well as other things. And as you can tell here, is one of the highlights is that in the end of 2013, they suffered a drastic data breach, which I think affected their stock price and some other key issues in the company. But here's some highlights of the analysis, and we'll continue moving from here. Here's a few key financial pointers for Target Corporation. As you can tell, they're a very strong company with cash on hand as well as an operating cash flow. Although a strong company, Target Corporation is underperforming in comparison to other retailers and must make assertive actions to remain a key player in the competitive retail industry. Recent performance indicates a bearish road ahead for the company, and it will take some time to recover from its current slide. I recommend the sale of Target stock due to its current position in relation to historic data, annual financial data, and the probability of change that will increase its liquidity, turnover, and profitability ratios. Expect more, pay less has been a key branding staple for the company. It opens its doors in Roseville, Illinois in 1962, and Target has been on a mission of delivering exceptional experiences for its consumers since then. The Target logo is one of the nation's most recognizable brands, and its annual sales have reached $71.3 billion, while nearly all operations are located in the United States. In 2013, Target made its first expansion internationally into Canada. Target sales are segmented by household essentials, food and pet supplies, apparel and accessories, and other hard lines such as appliances, electronics, and also sporting goods. Then also home furnishings and decor. The sales breakdown for those segments are 25%, 21%, 19%, 18%, and 17% respectively. Affectionately known as guests, Target consumers have historically been located within the borders of the United States. As of 2013, Target realized sales also from Canadian consumers. Due to a large number of product lines being sold, Target's consumer demographics range from children to senior citizens. As shopping trends dictate, Target's majority shopper is female rather than male. Very briefly, the retail industry is one of the world's most competitive industries, and it is defined as the industry that sells goods and services to consumers. There are various segments within the retail industry, including department stores, discount stores, specialty stores, and seasonal retailers, all exhibiting varying characteristics. For the purpose of this equity research report, we will focus on the department store segment, which Target competes. The retail industry has transformed tremendously over the last few centuries. Once a market where family-owned businesses dominated mail-order, catalog-driven sales, key players are now big box stores that leverage large distribution centers, inventory, and the ability to provide a browsable experience. Overall brand value lists Target at 29th in the United States amongst all brands, and only 3rd amongst retail brands. Overall industry sales topped 4.5 trillion in 2013. In terms of revenue, Walmart, Kroger, Target, Costco, and Home Depot take the top 5 spots. For retail companies responding to a growing online presence, Amazon poses a reputable threat. Although not a traditional retail company, consumers are ditching the shopping carts to shop online and have their needs delivered to their front door. This is an industry trend that has been growing with the advent of the internet. Some companies have responded better than others, and it is evident the online market will be an aspect of the future. Some key strengths for Target Corporation. One would definitely be its brand strength. And with that high brand strength, or that strong brand strength, it also brings a lot of brand loyalty among consumers. The company's price positioning has been consistent throughout the years of operation and has responded well to consumer behavior. The branding message matches the pricing platform, and the consumer believes Target is, in fact, a low-cost value store. Target's wide variety of merchandise options serves as a tactic to overcome tough economies. By carrying value brands in various economies, the company continues to grow revenue while most businesses struggle. Conversely, consumers shop at Target when their discretionary funds grow and they are more capable of spending on premium brands. As far as weaknesses, the one major weakness that Target Corporation and a lot of the retailers in this industry are facing is the electronics product sector. It's one of the more challenging segments to capture. If you can remember, there's even some companies like Circuit City who have failed over the last few years. Consumer is becoming more savvy in comparing prices and finding the most convenient option for them, and a lot of times in electronics, Target is just not one of them. Moving on to opportunities, I think one of the biggest opportunities for Target is their expansion into new markets, namely Canada. If you look at some of the chatter and some of the news stories, is that Target is also looking at other countries that they would like to expand to. And I think they've built a strong brand in the United States and North America to be able to do that. Another opportunity I see is the internet and the online channel. As I mentioned earlier, consumers are moving strongly towards the online market and also internet shopping. And I think Target is also set up very well to take control and capitalize on this move. Um, and lastly, the consumer is largely focusing on fresh brands, and Target is bound to make some great gains with their new P-Fresh logo. At a time when U.S. and Canadian markets are focusing on healthy habits, this is a great fit for Target to come in and capitalize on some new sales. Of the threats, I can definitely see the online channel as being a gift and a curse. There's a lot of opportunity there, but there's also a lot of opportunity for smaller competitors to enter the market. The political arena for retailers and for many large corporations across the world are facing a lot of flack from the consumer and also their employees for low wages, as well as higher employment costs or higher healthcare costs. Basically, the consumer preference for a variety of different products usually drives them away from the big box retailers and usually to the smaller boutique shops and the small businesses as well. Now, for my Porter's five competitive forces, there is a little overlap between the two, between this and my SWOT analysis, but I highlighted a few key points. As far as rivalry, of course, rivalry is high in the retail industry. Pricing battles dominate most margins for most of the companies in this sector. But then the switching costs are relatively low, which is also accompanied by slow market growth. As most can tell, the retail industry is a very mature industry, and so any opportunity to grow market share or grow profits need to be capitalized on. It's very difficult. The threat of substitutes is high in the retail industry as well. Online retailers threaten the traditional means of purchasing items. As I mentioned before, Amazon and sites like eBay, are entering this retail segment and are gaining traction very fast. Consumers becoming more confident in using their credit card or using that online channel to buy their goods and services. And then also the price check is more relevant. One of the things that you look at substitutes that can come from a number of different websites online or a number of different sources. So I think Target Corporation has to be aware of that. Then a little bit of a bright side for Target Corporation is the buyer power. There's a large amount of buyers. Essentially, everyone in the United States and now Canada is a buyer for this company. So no one really has any control over what Target sells and what price Target sets it at. So from that aspect, the buying power is fairly low for Target Corporation. Very similar to buyer power, the supplier power for the retail industry, Target Corporation, is also very low. If you look at it, these big box stores and the larger retailers have a lot of control over the items that they buy. They know that one big order usually make or break a lot of their suppliers, and I don't think they take advantage of it, but they do have that power, and it lends a lot of positive notes for them. Now, the barriers to entry, one of the things that keeps a lot of the competitors away are that the profits are shrinking. In the near future or any time in the future, really, you don't see a big jump in profit. So the profits aren't very large at this time. And then also the amount that Target Corporation and its competitors buys. This allows a lot of these smaller competitors from entering. Usually, Target has the ability to strong arm a smaller competitor, or use their buying power to keep one out. This slide shows you a quick snapshot of the key executive officers, and on the next slide we talk a little bit about the compensation, which lists their largest shareholders. Here are the major shareholders. As you can tell here, most of these employees have been with the company for quite some time. And then also Greg Steinhoffel, he was a prior CEO, which means he has a lot of stock as well. Here's just some key financial news stories over the last year or so as it pertains to Target Corporation, and basically gives you a pretty good understanding of some of the things that they've dealt with over this last year. So next we'll be moving to the quantitative analysis. So jumping right into the ratio and the financial analysis. One of the things you see right away is that the current ratio of 0.91 shows the target is just below the average or recommended ratio of 1.0. But they are an average for most retailers of their size. The quick ratio of 0.22 shows that the inventory serves a fairly large portion of their current assets. And once again, this current ratio is seen throughout the retail industry, as most of these companies are merely resellers and they hold inventory for their customers. And the cash ratio of 0.05 shows that Target's ability to pay its current liabilities are low. However, only a very short-term creditors will be interested in this ratio. Also another average for this industry. The following table shows the financial leverage for Target Corporation based on the most recent fiscal year, 2013. The ratios determine the ability of Target Corporation to meet financial obligations over an extended period of time by evaluating the total debt ratio, debt to equity ratio, equity multiplier ratio, times interest earned ratio, and the cash coverage ratio. The total debt ratio shows that for every $1 in assets at Target, there is about 64 cents in debt. The debt equity ratio exhibits a fair amount of equity compared to debt. Both Both the times interest earned ratio and cash coverage ratio show that Target has the ability to meet its financial obligations and generate cash. Okay, so moving over to the turnover ratios. The inventory turnover rate of Target is extremely low for the retail industry and projects favorable financial data for the company. Additionally, the days in sales inventory ratio is on par with their competitors, which means Target does not have a problem moving inventory out of its stores. There is no data for receivables because Target sold its credit card program to TD Bank before the fiscal year 2013. They've already realized the gains for that, so I listed those as non-applicable. The total asset ratio paints the big picture for Target. It is a clear picture that the company has the ability to make further investments after its Canadian entrance. Next, we have the profitability ratios. A profit margin of 29.67% shows that Target has a fairly strong ability to pay expenses with its revenues. A return on assets of 4.42% for Target shows that it makes a really healthy income compared to its total assets. And a 12.14 return on equity shows that Target values a strong relationship with its investors. In terms of the market value ratios, the current stock price of Target is relatively flat when compared to the last few years of stock data. Looking at the high market to book ratio, we see that Target has been performing at a high level with respect to its investors. Here, you can see the return on equity in terms of the DuPont analysis. One of the key things that the note here is that the 12.14% that we found using the DuPont analysis is the same as what we found using the profitability ratios, the 12.14%. So here's a little bit more information of that time series analysis as it pertains to EBIT margin, interest burden, tax burden, asset turnover, leverage, and once again, the return on equity there. Here we're going to dive into the risk and return section of the report. As you can see, the risk-free rate here and the beta, they were both attained from Yahoo Finance, and also the expected rate of return was attained from the S&P 500 index. As you can tell here, the expected rate of return is 12.86%. So for the valuation, I used the forward PE listed on Yahoo Finance, and that was listed at 19.09%. And I used that to forecast a price for 2014, which I took the earnings per share forecast for 2014 and multiplied it by the forward PE to get my 53.83 cents for the price target for 2014. And then also I did an evaluation of the present fair value for 2014, which comes out to be 49.26%. The target price for Target Corporation will be 53.83% for 2014 in comparison to the current market price of 61.57%. Additionally, for an investment in Target to be a good investment, it would need to generate a return of 13.5%. The expected return is 12.86%, which at the current time makes Target an unfavorable investment. Thank you for watching the Equity Research Report of Target Corporation. Once again, my name is Kadeem Myrick. I hope you enjoyed.